Rick, the numbers should be there right about now.
Yeah. Drum roll, please. Our December preliminary, I want to underscore, preliminary read on durable goods up 2.4. Holy cow. That is multiples of the up 0.3 we were expecting. But there's a bit of a fly in the ointment. Last month's final read on November was down 2.1. That now stands at down 3.1. But nonetheless, up 2.4 on preliminary is solid. Maybe look at the two together. And if we strip out transportation, we zap all the strength away, down 1/10. And if we look at capital orders, non-defense ex-aircraft, a proxy for business spending, capital spending. It is also not a good number, down 0.9, sequentially following up 1/10. Shipments versus orders, also weak, down 0.4. So if we look at this, it doesn't paint a great picture, although transportation obviously was the negative. We see that on the headline, and there is your good news. Dollar index up a little bit, as Joe pointed out, Andrew. 160 was our bottom yield yesterday, and here we're maybe trying to build on it. But in the grand scheme of things, we could talk about coronavirus, and obviously it's an important issue. But at the end of the day, it's not as though interest rates have been firm at any point in 2020. Back to you, Andrew.
Hey, Rick, thank you for that. Meantime, Steve Liesman is looking at some of those numbers as well, and you're making faces. What are you suggesting?
You have this like 168% month-to-month increase in defense aircraft and parts. So I guess the government counted a big order of the Defense Department of military aircraft, and that's why you seem to have this outsized increase in new orders. And you take out transportation, it's down 0.1. And look, this
non-defense capital goods down 0.9%.
Non-defense capital goods. That's the one we watch. That's the business investment one. That's the one that people believe was hurt by trade and the uncertainty around trade with tariffs. It did not come back in the month of December. I guess you didn't really even have the deal by then. So this is the one we're going to watch to see if you have this rebound that is going to help the economy this year because of the phase one trade deal, perhaps reducing uncertainty and seeing a business return to better business investment. But it has been a feature of 2019 that you had this really lame business investment numbers when it came to capital equipment. And there was no knock-on effect from the tax cuts. And the thinking was that perhaps this was because of trade, because it did.
Which that's December's number before the trade deal was signed.
Right.
So what happens? And that's the question we put to a lot of.
What did they tell you in Davos, Becky? That's really what I want to know.
Jamie Dimon said he thinks that you will see an increase in capital expenditures this year, that businesses will step up and maybe be a little more confident in doing things. But he didn't say it with massive enthusiasm. It wasn't a pounding the table, this is going to happen. I think you've still got things like what happens with trade with Europe, and that could be a big issue, too.
So what our Fed survey showed when it came to the issue of trade is every positive had another negative. Good, phase one trade deal. Bad, the bulk of the tariffs are still in place. Good, we have this phase one trade deal, but bad, we don't expect any improvement in relationship with China. And now the survey also showed there's concern about what happens with Europe when it comes to tariffs.
Right.
So
and that's a theme we heard again and again, because the president and his administration, members of his administration, certainly pushed up the idea that these tariffs for Europe or some sort of trade issues with Europe could be moving to the forefront.
And none of this says the president is wrong about what he's doing. It's just that here's the cost. And the cost may be in the form of business investment, in the form of lower GDP, if the trade issues are the reason for this decline of business investment we've seen.